All right, welcome back, everyone. Hope you guys are having a great day as always. This is a impromptu community recording, so all of you who are joining in live via the Capital Mindset Club, welcome. And for those of you who are watching on YouTube after the fact, also welcome. Hope you guys enjoy this conversation. So essentially, I'm going to keep this conversation to limited about maximum 30 minutes, but some conversations were spurred, you could say, and the timing of my availability unfortunately has it so that I'm recording this with you guys at an inconvenient time, although we have quite a bit of people in here, surprisingly so, again, given the time that we're doing this. But the first thing I'll kind of discuss or lead with is where we are seeing yields go, because that's a huge part of the conversation, and how that connects with utility stocks in just a second. But the 10-year is continuing to hit new highs in terms of yield and new lows in terms of price. What I have in front of you is the TLT, which is a product that you could use in theory to get exposure to long duration bonds. The average yield is over 20%, sorry, not 20%, 20 years. And I said yield, I meant to say duration. So you have a very sensitive instrument to interest rates. I've talked about some stocks here in the club as far as what would also give you a very similar, if not even more exposed / leverage play on yields coming back down. The yield curve continues to be inverted, which again still remains a concern as far as we don't really know what the black swan, so to speak, is. That's what makes it a black swan. I don't know what the trigger is. I can have some assumptions about it, but I can't really put my finger exactly on it. So where we're beginning this conversation with yields, because it connects to the second part of the conversation, which is about utilities, and one in particular, which is NextEra Energy. I don't recall if I have done a video on this one in the past, but I've done a video on Verizon, and you can go check it out. It's titled 3 Stocks You Requested Subscriber Request. I recently just included the tickers, MU, Disney, and Verizon in the description. But why I'm shouting out this video is one of the topics or points I illustrate with Verizon, and why I didn't think Verizon was a buy back then, even though at the time Verizon was a favorite stock amongst retail for both the higher yield back then, and it's a much higher yield now, and the Buffett effect, you could say, with Warren Buffett, it being one of his holdings. A lot of people were interested in Verizon. Why I wasn't interested in Verizon is, if you recall, I made a lot of videos last year about the various topics surrounding the liquidity crunch. And all that to be said, the liquidity crunch, it basically all encompasses a higher yield environment in the medium to short term. It was unfavorable to purchase equities or companies that were going to be heavily exposed to restructuring of debt. And let me rephrase restructuring, because that sounds like a bankruptcy, but pushing debt farther out into the future, refinancing debt. And something like Verizon, which is highly indebted, definitely has to do that. Their infrastructure is quite expensive, and they don't have the cash on hand to pay off all the debt that matures. And so if rates are much higher for a much longer period of time, they're going to refinance that debt at higher and higher rates, increasing their net interest expense and lowering future earnings. And therefore, we should, in theory, see the stock price react unfavorably to that news. Very similarly, you should expect that with utility stocks. So NextEra Energy over here, if I'll walk you through the financials in a second, but let me actually first start with the ETF XLU, which covers the entire sector. And you can see, let me actually pull up XLU, and let me see who, oh, it's a spider. Okay, so unless I already skipped it with my eyes, was there a website over here? Yep. Okay, and I just want to go to their top holdings. Skipped over it. All right, here we go. So NextEra Energy is the largest, and that's what I wanted to show you guys. So NextEra Energy market cap of 105 billion, which I'm pretty sure is the largest by quite a bit. And then Southern Co, Duke Energy, these companies you might be more familiar with. NextEra Energy is actually a Floridian-based company and has focused on the, let's call it, green energy revolution. So it being the largest weighting is going to be our topic of conversation. We're going to focus on it because it was the focus of conversation within the club. So NextEra Energy has been quite a growth story. If you exclude this recent underperformance or bit of underperformance in this past year, it has done fantastic since, the 2010, just picking a date. And it's done what? Excluding dividend, almost 600% to the peak. Now, recently, if you look at the 5-year performance, that has underperformed the market. Year to date has obviously underperformed the market, and on the 1 year has underperformed the market. Taking a look again, going back to that 5-year performance, you can see that we're almost back to the COVID lows. Now, what's going on? I think it's quite simple to kind of illustrate. This is a higher for longer play, or not higher for longer play, excuse me. It is being punished because of a narrative of higher for longer. So if yields are going to remain higher, the utility sector will be less favorable. Now, let me kind of expand upon that because there was a great question from one of our members here saying, okay, I understand that yields would dramatically affect or affect the attractiveness of investing in a utility. Okay, because I'm looking at a utility for safety, relative safety, and yield. Okay, if the yield on a safer instrument is now more attractive as an investor in aggregate, why would we allocate capital to the utilities? Fair enough. And I would agree with you that that is the general idea behind the relationship between treasuries and things like utilities. Now, where I kind of want to start with, because the question then expanded and said, I understand that, but why is it so drastic all of a sudden? Well, what's changed in the last couple months or so is the duration at which the market perceives those yields to last. So with yields lasting longer at these levels, the market now is looking at utilities more unfavorably. And this has a variety of implications. And why I started with talking about my conversation about Verizon and how that relates to utilities. Well, utilities rely on borrowing money to support their infrastructure. They don't have the cash on hand. If I go to any of these names right here, you will see they are all laden with debt. And that's not normally an issue, operationally speaking, because their business lines are very stable. They have government enforced or government backed monopolies. And so if you know how utility basically functions, they don't necessarily make money from the actual charging of the customer. They make money elsewhere, and they can only increase the price of the product or of the service in relation to the agreement they have with the local government. So government enforced monopoly, very stable business under normal circumstances. Even right now, I wouldn't say it's earth-shattering or company-destroying situation. It's just destroying or reducing the future value of all those cash flows if we start to model out how the net interest expense is going to increase in the near future. As if we have higher for longer and they have to refinance at these higher and higher rates, well, again, there is quite a bit of debt. So we could expect the net income over time, over the next couple of years, to fall, or at least our projections need to fall. So that's why we're seeing a nice drop recently. And that's the connection that I want you guys to derive there. So essentially, it's just the narrative has flipped from we might see some cuts in the future to we now don't foresee those cuts happening in the future. And so, again, higher for longer. Now, that might be an opportunity for you to step in. And if the contrarian in you is saying we are going to cut before the market or the narrative right now thinks we're going to cut, well, then therein lies your opportunity, because I would argue that the utility sector and NextEra Energy in this case, because NextEra Energy is also has a lot of tailwinds from both a narrative perspective, because it is the preeminent investor in renewable energy. Again, by even the name, you could say. Let me see. Here's a question. So this is bullish for PCTY. If you aren't contrarian here, yes. So again, this is public content, and I believe Andrew has also pitched or discussed that within the club he is covering Paylocity. And so if you guys haven't seen that, there was a live stream where Andrew actually came on for public content, and he actually walked through the Paylocity pitch. So yes, this is actually public content. At least I'm going to publish it publicly. And then if people decide to watch it, they decide to watch it. But this is also meant for all the club members to also watch and, kind of cover this conversation. But, Andrew wants to make sure that everyone knows that he doesn't say that at all. He actually changes his mind and says you need to buy Tesla and Palantir. So you should buy Tesla and Palantir. And that's that. Don't worry about anything else. Buy Tesla and Palantir. So I would agree. Any of the companies that we've discussed that benefit from higher for longer interest rates, I would probably, if that actually is the case, by the way, if we do actually see higher for longer, then their projected net incomes, we should be actually increasing that. And there's some names that come to mind. There's even some of those meme stocks that come to mind. I wouldn't call them necessarily meme stocks, but highly concentrated retail investments. There's one in particular that comes to mind, and that's Robinhood. So Robinhood has quite a bit of cash on hand, and their net income primarily has been coming from, at least strongly boosted by the interest income that they've been able to generate on their cash pile. So if we have higher for longer and maybe even higher rates going on in the future, that bodes well for something like Robinhood. And then some other banks, you could also make this argument that this also bodes well if we don't see a credit risk event. So, there's something to think about. But all in all, that's kind of my quick conversation about why NextEra Energy and other utility stocks have come down so strongly. It's just a change in narrative, and I'm trying to, hopefully I made it sense or walked you guys through in a way that makes sense why the market is repricing a lot of these utility stocks suddenly. Well, it's because, again, if you model out the forward projections, you have to make those reductions for the refinancing and thus higher interest expense. And so their net income would go down. Okay, so, and cash flows, by the way, whichever way you want to look at it. Now, what are some of the things that I've been doing? Because I guess this is not a portfolio update per se. And for the club members, because you guys get access to this, the brokerage screenshots and all that, you guys will probably get that, I guess, later this week, because I want to finalize all the purchases this week. But today was really small purchases. I already updated you guys in the portfolio updates as to what they were. Again, you can see I even kind of said or showed the dollar amounts. They're quite small. But I've been adding more to Agree Realty, and Higher Quest. That's the other one I've been adding to. So just small buys, really small buys. Now that kind of comes into some of these REIT names like ADC, right here. ADC is actually trading at 5.41% yield now, down 2.52%. Recently we had a really strong insider purchase from Joey Agree. And I believe it was 30,000 shares? It was something quite large. Don't quote me on the amount, but just note it was a large sum. Now it's not perhaps super material for himself. I don't know what the percentage is what I'm getting at. I don't have that information in front of me, but in isolation, it was a big chunk. Now that doesn't mean it's a buy, but they are also suffering from a similar narrative, because again, you're dealing with an entity that primarily uses debt and equity to find properties and purchase them. So if you have a higher for longer environment, one might come to that conclusion to say, hey, it's it's probably going to negatively affect their ability to both raise capital, generate a spread between that said raised capital and new property acquisitions. Just a hunch. That's probably the case. So Agree Realty, though, is my champion, so to speak. I have talked about it within the club as to why I prefer them over Realty Income. And I think that narrative is now proliferating across YouTube, not because it generated from myself. I think it's just the obvious choice. And Realty Income, I think, while it is actually starting to get quite attractive, the yield, it's approaching we'll see, maybe it even gets to the 7%, is really reflective of the current state of REITs, and specifically triple net lease REITs in the retail sector. So it's just, again, that same worry that cost of capital is going to increase or has been increasing for these entities, and they're unable to generate the spreads they once were. Now, this might be an interesting entry point for people who think that yields will come down at some point in the future. And if that is the case, then you are being presented with potentially a very interesting buying opportunity. So right now, my total allocation in terms of real estate or REITs is roughly about 10%. Some members in the club are much more allocated than I am, some less. And some, have various opinions. I really highly recommend, for those of you who are listening in the club and you guys haven't checked out McBuda's write-up on REITs, I highly recommend you go check that out. You give it a read, and I think you'll find value in that. And for those of you who are watching, this on YouTube, that's a write-up within the club. But so that just some context there. He said, sorry, Rich, keep buying. What is this? So I'll go ahead, because we're talking about this in the chat, I'll go ahead and show this to YouTube. Happy to be buying today. Cheaper, Joey, agree. But price now is at the mercy of 10-year yields. LOL, I'm in it for the long haul. Who said I was done buying? Yeah, well, I mean, I really like that he's putting money where his mouth is. And that's one of the things that attracts me to Agree Realty. It's that the management team is highly invested in the success of the enterprise. Realty Income's management, again, by virtue of it being so large, I kind of give them, a pass on that. But if you look at the percentage of the business that's owned by the insiders, it's not that much. Agree Realty, it's a wholly different situation. But I see some of the comments you guys are. Yes, that's the CEO of Agree Realty. So if you guys have been following me in the club and you've heard my commentary on Joey Agree is very outreaching to retail investors, which is quite odd. It's not the norm for most of these larger companies. So Joey Agree is actually quite reachable. Did you see B of A made a chart of interest rates going back to 3000 BC? No, can you actually share that with me? I actually didn't get to see that yet. And then, thank you. Already there. What a wonderful... Okay, just coming off 5,000 year low in rates. Okay, so global investment strategy, Bank of England, global... Okay, so interest rates. What this is then illustrating is that we're getting back to the more or less the average, and I'm just eyeballing the average, like a median line through the middle, and I would argue, okay, that is fair point, right? And it's a fair observation. I think it's just kind of comedic almost that they go back 3,000 years, but I wouldn't necessarily feel, I guess the best way to say it is concerned. I mean, granted, and for full disclosure, I shared it with, I believe I shared it on Twitter. So I have a community post, if you're watching this on YouTube, where I posted the portfolio results since I've been on YouTube. And I posted even the portfolio performance of the holding co, which is the just shown to the members here in the club. And I also showed the allocation or the cash allocation for the personal holdings, which sits at a roughly 26-27% presently. And then in the holding co, well, this is where I give you guys an update. So right now, because of the contribution, the second contribution for September, we're sitting at, let me do the mental math, it's roughly 10% cash allocation. You guys will see that in the screenshot this week, unless it changes a little bit because if I buy something. But right now it's sitting at about 10%. And then if you include the holding co cash account, that's going to be sitting at roughly, mental math, yeah, well, actually that's quite a big chunk of change. So probably altogether 30-40%. But I told you guys the caveat that cash account's not meant to be invested. So it's, consider it maybe not cash to be deployed in the market unless things get crazy. But in the personal, that is cash that's available to be deployed. And so I'm not really freaking out. So it's put me in a position where I can kind of be calm, and if the market gives me pullbacks, I'm not going to worry all too much. In fact, I'm getting quite nice yield from the bank now at 5.15%. Yields keep rising, get more yield. And I've tweeted, actually, by the way, this is an invitation. If you don't follow me on Twitter, go ahead and follow me on Twitter. I tweeted the other day why rates right now, you know, I get it. It doesn't put me in a rush to invest. I know, I am hunting still, but it's nice. It's almost like, how do you even say it? For lack of a better term, it's like calming to get nice yield on your cash. So it rewards my patience. I'll say it that way. It rewards my patience. Bullish TLT. Oh, I see, because that person is now bearish TLT. I won't put, yeah, no, not 5.15% a day, 5.15% yearly, annualized. So, and interest is paid out at the end of every month. It's amazing, not gonna lie. Yeah, no, it's great. It's absolutely great. So, and I'm very happy with the product so far. When I mean product, I mean banking product. Okay. Now, what are the broader, I guess, investment theses that we've been following? Well, they've been pretty much more or less the same. I am taking opportunities here and there to round out the portfolio. Yes, like I am looking to increase some of the small cap positions. I won't get into them too much here publicly on YouTube, but some of the small cap positions that you guys see in the club. And then some of the other investments, such as actually Zebra Technologies, which might be making a comeback here in the holding co. Hasn't moved in the personal holdings, but in the holding co. It's going to be making a comeback here soon. And by the way, there's no restriction on myself for tax purposes, because as we always discuss, when I sell a position for a loss and I'm trying to, harvest the loss, I have to wait that 30-day period in the holding co. Well, with Zebra, because it was a gain and it was an accidental trade of sorts, it wasn't really purposeful. There's no restriction. I can buy back whenever I want. And they're not going to be like, oh, now you can't recognize the gain. It's like, well, that would be a benefit. No. And the other position that will probably make a comeback at some point, but I have to really wait. And we'll kind of get into both of those positions here or talk about them, was Disney and Dollar General. Let me talk about Dollar General. So if you're watching this on YouTube, you're not up to date on this, but I have severely reduced the holdings in Dollar General because the Michael Jordan of investing, for those of you who don't know who that is, you're missing out on some capital mindset lore. But the Michael Jordan of investing said that Dollar General was a buy. And so I had to, because he doesn't miss. This person, actually, you know what? That's actually a really fitting name. Michael Jordan of investing, because they do not miss. They do not miss. They make every basket. And it depends on what basket you're talking about, because it's more like shooting the basket on your own team, and that's the basket he doesn't miss. He doesn't seem to know which side of the court he's supposed to be facing. So when I know that he has the ball and he's eyeing that direction, or he's playing that team, I have to step away, just because he has the perfect track record in that direction, and I can't do it. So I took that opportunity and reduced it severely, which, granted, the actual allocation to the portfolio wasn't all that big to begin with, but hey, money is money, and so we reduced it. And we'll just wait on the sidelines for now. So again, that's new to people on YouTube. That's not new to the club. And someone is guessing. They'll look above you in the chat, and you'll see who it was, because you're not up to date on this. Bitcoin salesman. By the way, if you're watching on YouTube and you hear me talking to someone on the side, it's because I'm referring to the club chat. And they're asking questions, and then I'm just addressing them. But yeah, Bitcoin salesman, look up in the chat. The other members have basically said their name via images. This guy's now valuing companies. Who is? Wait. Can you say the name, Andrew, on who's doing that valuation process? Oh my God. All right. Well, but basically what I'm being informed is the Michael Jordan of investing is now using a very questionable valuation method to value companies. More of a reason that when he likes a company, I avoid it. When he doesn't like a company, that's maybe the time you should actually look at it. And it's funny, he doesn't like Amazon. Maybe that's the sign that I need to focus on buying more and more Amazon as much as I can. Let's talk about a little bit the developments in Google, or what's happening with Google, with the Department of Justice, and the upcoming decision on whether or not the agreement that they have with Apple is valid or not. And I saw on the news the other day, I believe it was a CNBC report, that the CEO of Microsoft, Nadella, he has been vocal against Alphabet's monopoly in the search business. And I find that fascinating. I find that interesting, to say the least. But, hey, it's somewhat the external politics of corporations, and he's shooting a shot. He's trying to weaken his opponent here. Alphabet, if they were to not be allowed to renew that contract with Apple, I think that would be a question mark, nonetheless, obviously. And it might bring into question somewhat the narrative of Alphabet. Maybe that would be a great buying opportunity. Some of you might look at it as that. I'm not too concerned right now. And I'm not buying more Alphabet, but I'm not selling more Alphabet. Actually, more Alphabet selling. I haven't sold a single share. But yeah, it hasn't really reacted too much to this potential, and that's just something that to keep an eye out for if there is a ruling that could weaken the share price. So recently, or year to date, Alphabet's actually performed really strong, and I've enjoyed it in the portfolio because Alphabet last year was one of the ones that was dragged down, was a drag on the portfolio, and then this year it's been a boon to the portfolio. So hey, it's been great. Don't tell me he's going to play TLT on a rate hike bottom. I was thinking of doing that. I have no idea. I have no idea if he is or isn't. Someone else can answer you, because I don't watch that individual's content. So for me, I just don't have the time to pay attention to it. Although some people should, because they can be good contraindicators in many instances. I'll also talk about briefly, if you guys recall the memes I used to make on the trash companies, there is only one company left. Actually, no, there's two companies left that, depending on the meme you look at, that have to go bankrupt. And then all the companies will have been bankrupt, which is already kind of awesome that at least 3 of the 5 went bankrupt. I mean, that's a pretty good streak. Bad for the person who invested in that, but pretty good for, kind of like of a joke to say, oh, like, look at these trash companies, and then 3 of the 5 are no longer with us. Hey, and that's not even, that's like a year ago now. So pretty good, pretty good. And then all in all, I'll kind of finish off with the conversation around what I'm kind of planning on continuing to invest in the future. Like, how aggressive am I going to be? What are my hedges? Do I have any hedges, right? And so I'll start off by saying, do I have any hedges? Well, my hedges are frankly right now just cash. I actually never ended up buying put options on my Meta position to use them, right? I haven't done so yet. That doesn't mean I won't, but I haven't done it yet. I actually do have some call contracts that I've shared with you guys here in the club. I don't know if I've shared it on YouTube, but I have shared it within the club. So just to get everyone up to speed, again, if you choose to watch this on YouTube, now you have this information. But just for full disclosure, I have some contracts on some portions of the Meta position, not too much. And it's for a 315 strike expiring February 2024. So, that's, again, I'm okay with selling that portion of Meta. That would bring down my Meta position just a little bit. I generated some extra yield, and it's past the long-term capital gains, so I wouldn't, cry too much about it at all. I'd be fine with it, all things considered. And as far as anything else, it appears as though my Salesforce contracts that I know I have disclosed both on YouTube and in the club, but if not on YouTube, then I'll discuss that here. I also have some Salesforce contracts expiring in December, strike price 295, and I do not think I'm going to get called on those, which is fine. I was willing to sell Salesforce at $295. And at the time I sold those contracts, the share price was, what was it, 240 something. It was getting up to a point where I believe the rally for Salesforce was a bit overdone, because the thesis for Salesforce was very similar to that of Meta. It rhymed with Meta. It was simply that, Salesforce has the scale and ability to produce tremendous amounts of cash flows should it so choose to, and management was telling you this. You just had to, kind of listen and say they're right or they're wrong. In this case, they were right. Okay, so apparently there's some interested in this stock. Oh no. Well, I won't bring this up in the video, because that will just be for the club. But that's some interesting little juicy drama there. No, you're good. You're good. Everyone who's watching live, go ahead and follow Andrew's lead there, and I guess look at minute 3. Let me know in the comments what ticker it is, so I can maybe discuss it a little bit. So, and then DocuSign. Oh, well, DocuSign. What can I say about DocuSign? I forgot DocuSign's, is it Docu? Yeah, it's Docu. So DocuSign was a darling for a while, and it was a Cathie Wood favorite. I wouldn't call it darling, maybe that's the wrong word for it, but it was a Cathie Wood favorite, and the economics of the business are really strong. However, it's almost like a commodity type business. A lot of other companies have also introduced similar services. You have Adobe Sign, you have HelloSign, you have, I can't remember, there's a couple other ones. I think Cisco has one even. CogniSign, thank you. It's not very difficult to replicate. And so the moat is quite questionable here. So when you pay nosebleed prices for growth that, mind you, was during a pandemic, where a lot of businesses were trying to modernize a lot of their customer facing systems, and something being, hey, let's find a way to collect signatures digitally, remotely, without being in front of the person. Well, DocuSign was there, and so it benefited from that need and desire. Now that we've kind of become or returned to a more normalized economy, and we are seeing a lot of legacy systems revert to where they once were, a la return to office a little bit, Zoom returning to office. That's not saying that DocuSign isn't still useful, and something that is a digital signature is, of course, going to be useful, and I think that's more or less the future. It's just that the same level of growth isn't present. And so when the market is pricing that continued growth, and okay, that initial event that caused the growth is no longer there, it's diminishing. And on top of that, you're getting a lot of pressure from new competitors entering the market. That doesn't bode well for the share price. So here we are at a 5-year return down 7.82%. And then year to date, it's down 26.47% in the midst of a tech rally. Now, granted, when we say tech rally, what we really mean is big tech rally, because the majority of the market move this year has been from big tech. And so the market, I think this should be obvious to everyone watching both on YouTube and in the club. The market moves in, let's say, reshuffled or rebalanced sectors or themes, right? Factors, we can call them factors. So different factors will perform better in a given year. Knowing what factor will perform better, okay, that's the really important question, right? And if you know that, then you can position yourself accordingly. But knowing that is something else entirely. So right now, if you position yourself appropriately in 2022, you set yourself up for that year, and then if you set yourself up the following year, great. Arguably, you can kind of try to position yourself in that desired. Let's again use the word factor. And then within that factor, maybe you elect to not expose yourself just to broadly speaking that factor, but you try to find companies within that theme that you want to allocate capital to. So what I'm getting at with is right now, small cap tech has really underperformed. I think, let me see if Viva Systems, how they've been doing, but I think Viva Systems hasn't performed all too well. No, okay, never mind. Scratch that. They're up 26%, so they're doing all right. I was trying to kind of gauge what is the size. Let me go through some unprofitable small cap tech. So like Domo. Okay, so Domo, yeah, this is a analytics software company. Wow, absolute destruction. AYX, I know they haven't done too well. Down 26%. Let me think of another one. I think Sumo went. How's Frog doing? So Frog is up 15%. Okay, so they're not down too much. Elastic. So Elastic is down. Oh no, Elastic is doing great. Okay, so scratch that, and let's look at Blackline. Blackline down 20%. You're gonna have Splunk, SPLK. They're getting acquired potentially. So now that's the one that's performed really well. But funny enough, I think in a 5-year, it's still not doing well. It's just if you purchased them in the past year. Yes, Fuhat?
You do realize that AXY might be getting acquired too.
By who? Who's the rumor?
I didn't look into it fully, but that's the rumor is they're actually looking for a sale.
Oh, they're looking for a sale. Okay, well, that's now them telling the market, hey, we're looking to sell ourselves. Yeah, because growth has dried up. I think they need to be part of a larger enterprise solution that can integrate multiple solutions to a client base. It's kind of like what Salesforce does. Salesforce, you get into one of their products and they can upsell you with other products. So Salesforce's competitor to Alteryx, Tableau, it's there, but you don't have to only have that one relationship with Salesforce. You can have Tableau and all the other stuff that they have. Alteryx is just Alteryx. So I think it makes sense. Right now, the market hasn't been rewarding Alteryx at all. I can tell you, actually, I remember some of you weren't maybe investing back then, but this was a very, you could probably find the videos of Jim Cramer and Alteryx. Just type that in YouTube. And you'll see him touting the 100% plus revenue growth rate from Alteryx. So, this was not a darling, but it was a very fast growing company. a lot of investors back in the day were all over this stock. Back in the day, as in, less than 5 years ago. Like I'm talking 2019, 2018, roughly around there. So yeah, like this period when I first IPO'd there. Let's see, Bill has been flat. Yeah, so I'm trying to get at there's a couple smaller cap tech or mid cap tech that just hasn't done well. A lot of the large cap tech has done really, really well. So let's see, Funko crashed. Cognizant, yeah, Blackline, yeah, we're talking about Blackline. Bill is flat year to date. I don't know if it's small though, and that's B2B. Also, I mean, the other part of the economy that has, not an economy, but the stock market that's done really poorly, again, deservedly so to a huge extent, is fintech. Fintech has been absolutely trashed for a while. So you had some of these other names like Global Payments has had a rough couple years, and then we all know PayPal. PayPal's been just absolutely smacked now. You can see that now we're sitting at $58.56. Let's see. I think FIS is also still in the lows. You have AMZN. Let me pull them up. Yeah, the only one that's done really well is Fiserv. I'll pull up Fiserv in a second. So Fiserv is the owner of Clover. So Fiserv has a lot of different business lines that I guess you could differentiate them across each other. They bought First Data Company back in the day, and with that they got Clover. They have a lot of back-end software solutions for banks, and that's typically has been their bread and butter. They've also been quite acquisitive like some of their peers, and interestingly so, they've shown the most relative strength in the sector. While their sector as a whole has experienced a very turbulent couple years, Fiserv has actually done really well. I also want to because I remember this off of memory, back when I did a video discussing the Popular Investors portfolio, I remember he had a position in Fiserv. He sold the position in Fiserv to buy PayPal. No, I'm not trying to pick on him at all, but I'm saying like it's an example of, in his case, that was hindsight's 2020. But it looking back, he was like playing with the soap. He had an investment that actually, had he held, would have been in the positive, and he would have avoided the massive decline in PayPal. Now, I'm only mentioning that PayPal point because in my video, I did make a point to say why I believe their PayPal valuation was incorrect. That's the only reason why I'm mentioning that. But Fiserv, I didn't really look into Fiserv all too much. I might have a video on Fiserv. And I don't really remember what my opinion of it was, but it has shown really strong performance relative to its sector, which is really interesting. I might guess that has a lot to do with, again, their B2B solutions with banks, and how, despite everything, that's not really showing any signs of weakness. Again, makes a lot of sense because that's not really necessarily exposed to the economy. Yes, Fuhat?
You need to look at NCR.
I'm kind of dumb looking at NCR though, because NCR, I've made my money already on NCR.
Just look at this chart though.
Yeah, what do you see in the chart, Fuhat? I'll give the floor to you.
Oh, what I see in this chart? Well, this is now a spun-off business.
They've completed the spinoff?
Yeah, they completed the spinoff like 3 months ago.
What's the other business called?
Let me check.
And while you're talking, let me also make sure that your desktop audio is recording, because I should have checked that. Yeah, it's recording. Good. We'll close off here soon because I made a promise that it would be 30 minutes max, and we're at 44 minutes.
Thanks, Lycos.
All right. At Los on October 16th. Oh, no, it hasn't happened yet. Okay, so thank you for sharing the article. So it's going to happen on October 16th. Yeah, a leading end. Yep. Okay, so we should expect that to happen soon. All right, but it's good to know. Good to keep an eye on. But I've already made my money on NCR. I'm not too much in a rush to get back into this. I mean, there's other names I want to buy. That's kind of why. I doesn't necessarily mean that it's not a good opportunity, right? My previous opinions on NCR, they remain. They're not gone. So for those referencing it or haven't seen it, there was a pitch I did on NCR very beginning of this year. And it was, I think, roughly just under $20 a share, something like that. And then I'm no longer involved in the company though, so just full disclosure. And then for those who are watching on YouTube, same disclosure goes to you guys. But yeah, okay. With that being said, guys, because of the time that I'm filming this, I'm gonna cut it off here. I know it's kind of abrupt, but I did say 30 minutes, and we're at 44 minutes, 46 minutes, however long it is. But I really enjoyed it nonetheless. Thank you guys so much for watching, and I'll see you guys on the next one.